Good morning, everybody. Today's Wednesday, August 13th. I'm Jon Weigell, and this is the Hustle Daily Show. Just 5 months after emerging from bankruptcy with some confidence, Spirit Airlines dropped a bombshell warning that they might not survive the next 12 months, sending their stock crashing 40% in a single hour. Today, we're exploring how the yellow budget carrier took a dive from successfully restructured to substantial doubt about survival. We'll get to that and the biggest headlines in business and tech right after this. HubSpot helped Tumblr solve a big problem. They needed to move fast to produce trending content, but their marketing team was stuck waiting on engineers to code every single email campaign. Now they use HubSpot's customer platform to email real-time, trending content to millions of users in just seconds. The impact? 3 times more engagement and double the content creation. Want to move fast like Tumblr? Visit HubSpot.com. Okay, starting off our headlines today, Tesla's robotaxi business is still in its infancy amid some controversy, but that hasn't really stopped the company from looking to expand it. The company is hiring a robotaxi operator in New York City right now. The problem with that? Tesla does not have any permits to actually offer autonomous driving services in New York. Not yet, at least. Next, the founder of the UK's largest toy store chain, The Entertainer, is making a remarkable move to end his 43-year career, transferring 100% of the business to an employee ownership trust. Gary Grant's almost 2,000-person team will take a stake in the 160-store retailer and can expect to see a share of the profits starting in 2027. To make it extra sweet, a little more than 20% of the staff has worked at The Entertainer for more than a decade. How adorable. Up next here, Fabergé eggs, world-famous ornate art pieces, can individually be worth tens of millions of dollars. That makes VC fund SMG Capital look smart for swooping in with $50 million and just straight up buying the entire Fabergé brand, which also makes fine jewelry and watches, another one down to the VCs. And finally here, Starbucks Korea advised all locations to crack down on a group of patrons who definitely deserve to be cracked down on, called Kagong, the name of people who camp out for hours in cafes, working, or studying. So why are the clamps coming down on them? A number of Kagong had taken the practice to an extreme, plugging in full power strips and setting up their full desktop computers and, wildly, their own printers in the middle of a Starbucks. Also named in the ban are partitions after someone effectively set up their own cubicle in the middle of a Starbucks cafe. That is hilarious. For more stuff like that, you can subscribe to the show and we'll have more headlines for you in business and tech tomorrow. But in the meantime, just 5 months after strutting out of Chapter 11 bankruptcy protection, Spirit Airlines thought they'd conquer the world, but they dropped a bombshell this week that sent their stock plummeting 40% in the first hour of trading. The Spirit Airlines message to the investors this week has really just been, we might not be completely around in 12 months. When an airline goes from successfully restructured to substantial doubt about survival faster than a cross-country flight, you know something has gone spectacularly wrong. And Spirit's spectacular wrongness is a masterclass in how even the best-laid bankruptcy plans can completely implode. So strap in, everybody, for this corporate horror story, because we're about to witness what happens when an entire business model gets turbulence that it just simply cannot handle. So let's start here. Spirit's second quarter earnings report reads like a financial nightmare, to be quite honest. The company reported a staggering $245.8 million net loss on $1.02 billion in operating revenue for the quarter ending June 30th. That's a loss margin of almost 25%, meaning for every dollar they brought in, they lost a quarter. To put that in perspective, that's like opening a lemonade stand, spending $1.25 to make lemonade that you sell for $1 and then wondering why you're broke. Except instead of lemonade, it's commercial aviation, and instead of going broke, you're potentially putting thousands of jobs at risk here. Spirit's poor cash reserves have been dwindled to just $407.5 million, which sounds really substantial if you're me, but that's until you realize how quickly airlines burn through money. Between fuel costs, aircraft leases, employee salaries, and airport fees, that cash cushion can disappear real quick. The company's explanation for their troubles reads like a greatest hits album of airline industry problems. They're pointing to, quote, adverse market conditions, check, elevated domestic capacity, check, and continued weak demand for domestic leisure travel, check, as the major culprits behind their financial freefall. Breaking this down here, there are too many planes chasing too few passengers, and the passengers who are flying aren't willing to pay enough to keep Spirit profitable. The really painful part is that Spirit's bankruptcy was supposed to fix these exact problems when they filed for Chapter 11 protections in November, making them the first major U.S. carrier to go bankrupt since 2011. The restructuring was designed to eliminate debt, reduce costs, and position them for profitability some point down the road. During the bankruptcy process, Spirit has projected a $252 million profit for 2025. Fast forward to August, and they're warning they might not make it to 2026. That's not just missing your projections. That's like confidently predicting sunny skies when standing in the middle of a rainstorm. Spirit has been scrambling to stop the bleeding with moves that scream desperation here. They've announced a sale of 23 Airbus jets, delayed future aircraft deliveries, and implemented sale leaseback deals on spare engines. They're essentially pawning their most valuable assets to stay operational right now. The pilot furloughs are particularly telling here. In an industry already facing a pilot shortage, voluntarily reducing your pilot workforce signals either supreme confidence in reduced flying schedules or complete financial panic. Based on Spirit's warnings, it's definitely the latter. But perhaps the most ominous sign is the credit card processing situation. Spirit's credit card processor has demanded additional collateral to renew their agreement, which expires on December 31st, 2025. Think about that for a second. The company that processes Spirit's credit card payments is essentially saying that they do not trust Spirit Airlines to pay them. For an airline in 2025, losing the ability to process credit cards is really bad. I don't think I have to tell you that. Without credit card processing, Spirit couldn't sell tickets to most customers. It'll be an almost immediate death sentence because who pays airline fees in cash anymore? The company's attempts to go upmarket represent a Hail Mary play that might be too little too late, though. Spirit has introduced premium economy options, fare bundles, and other amenities that directly contradict their traditional unbundled approach, where passengers paid extra for everything from carry-on bags to sodas. The strategy shift acknowledges a harsh reality with Spirit Airlines. The race to the bottom pricing model that made Spirit famous may no longer be actually viable for any airline. Travelers have shown they're willing to pay more for better experiences, and Spirit's traditional customer base has either moved to competitors or stopped flying altogether. The competitive environment has become absolutely brutal for ultra-low-cost carriers. Legacy airlines have launched their own basic economy fares, offering Spirit-like prices, but with better operational reliability and customer service. Meanwhile, Southwest continues to dominate the value segment with their no-change fees policy and generally cheerful approach to air travel. Spirit is essentially fighting a two-front war against legacy carriers moving down market and against Southwest's continued dominance of the budget space. And they're losing both battles while carrying massive debt from their bankruptcy restructuring. What's particularly concerning is that Spirit's current crisis calls into question the entire bankruptcy process they just completed. Typically, Chapter 11 restructuring involves extensive financial analysis designed to ensure a company's long-term viability. The fact that Spirit is back in crisis mode so quickly suggests that either the market changed dramatically, which could be possible, or the original projections were fundamentally flawed. This has broader implications for how investors and creditors view airline bankruptcies. If a successful restructuring can fall apart this quickly, what does that say about the process itself? Looking ahead, though, Spirit's options are limited and increasingly unattractive. They can try to find new funding, but convincing investors to pump money into an airline that just warned about its survival prospects is a bit of a tough sell. They can sell more assets, but that reduces their ability to generate revenue. They can attempt another merger, but their previous attempt failed spectacularly. Or they can liquidate entirely, which would make them the first major U.S. airline to completely disappear since the industry's post-9/11 consolidation. The Association of Flight Attendants doesn't expect furloughs or changes to working conditions, but that optimism might be misplaced if the airline can't find its lifeline soon. Spirit's potential demise would mark the end of an era in American aviation. Love 'em or hate 'em, Spirit democratized air travel by making flights accessible to passengers who couldn't afford legacy carrier prices. Their disappearance would reduce competition and likely lead to higher fares across the industry. The company expects to face a, quote, challenging pricing environment through at least the end of 2025, which is corporate speak for things are going to get worse before they get better, if they get better at all. Whether those famous yellow jets will still be flying in 2026 depends on Spirit's ability to find funding, convince creditors to extend payment terms, and somehow turn around years of losses. Based on their recent warnings, the smart money might be betting against them, unfortunately. Sometimes being the cheapest option isn't enough if you can't actually afford to stay in business, and Spirit Airlines might be about to learn that lesson the hard way. This all serves as a big reminder, though, that in the airline industry, today's bankruptcy success story can become tomorrow's liquidation story, and it could all happen by the end of your layover. All right, that's going to do it for us today. Thanks for tuning into the Hustle Daily Show. We're a proud part of HubSpot Media. Our editor is Robert Hartwig, and our executive producer is Darren Clark. We've got a lot more tech and business coverage in our newsletter. If you're not subscribed, go get signed up at thehustle.co/email and follow us on Instagram at The Hustle Daily. We'll see you tomorrow.
Look, I'm going to be straight with you. Everybody's talking about AI, but most people are just playing around with ChatGPT instead of actually making money from it. That's why we dropped the ultimate crash course to create your own AI side hustle in 7 days. We're talking real frameworks and strategies from the pros, like the founder of The Hustle, Sam Parr. It includes mini guides, templates, the whole 9 yards, stuff that takes years to figure out, condensed into 1 week. Stop what you're doing right now and grab it in the show notes. Your future self will thank you.